We're half an hour away from the open in Hong Kong, Shenzhen, Shanghai. You're watching The China Show. I'm Annabelle Droulers with Stephen Engle.
Our top stories this morning: Asian stocks plunge while haven assets rise as the market turmoil sparked by Trump's trade war shows no signs of easing. The president says he's not intentionally fueling a sell-off.
China signaling rate cuts and other measures to defend the economy from tariffs as investors brace for steep losses when the markets reopen.
And Southeast Asian nations move to accommodate Trump instead of hitting back against tariffs, with Vietnam offering to remove all duties on U.S. imports.
Well, Steve, I think you said it there. Donald Trump says he's not intentionally engineering this market sell-off, but regardless of what he says, it is happening in the session this morning. Taking a look at what's happening in bonds this morning, treasuries, for instance, you're continuing to see them bid, particularly noticeable at the front end of the curve, and you're seeing that reflected across in the Asian session today. Currencies, I'll keep it quick. Let's keep moving through. Again, it's that flight to safety that you're seeing. The yen, the Swiss franc, we have seen those continuing to climb. The Aussie dollar, you can see there, you're at 60 cents. That is a level that we have not seen going all the way back to the COVID era, 2020. Shifting to commodities now, taking a look at what's happening with weak sentiment here across in copper. That is, of course, the global bellwether for the economy and really reflects those recession fears and all of this tariff risk that we're continuing to see moving through market sentiment. Again, gold even being pulled back below $3,000 an ounce. Brent crude as well. Not just the duty story. You've also got Saudi Arabia that slashed its prices over the weekend. Crypto, take a look at Bitcoin, for instance, below $80,000 a token. And again, US stocks, that's where you're really seeing a lot of this pain here. Right. Futures sharply under pressure. You're getting a lot of commentary coming through. Bill Ackman, for instance, saying that these Trump tariffs are a mistake. And then again, shifting into the Asian session, we'd already seen circuit breakers in Japan futures before we came online. Very, very much under pressure. Taiwan coming back there from a long weekend here, down around 10%. Now for what we see for China today, I think really the Golden Dragon Index on Friday, we saw that really sharp fall in the session. And again, you can see that really reflected ahead of that sentiment and that flight again back into Japan government debt.
I mean, there's just so many comments coming out of the United States, and it's a Sunday, of course, ahead of the market open with the S&P futures down again. Could there be a third straight consecutive sizable downturn in the market? So you mentioned Bill Ackman, Nouriel Roubini also talking, Lawrence Summers, a number of different notable names talking about the impact, obviously, and the lasting impact of it. And the question is, how can you or do you get the toothpaste back in the tube over the last couple of days? Let's bring in Helen, a managing partner and CIO at NF Trinity. Thanks so much.
Morning.
It's the proverbial toothpaste out of the tube. How do you get it back in? What's going to be the panacea for this market turmoil?
Well, I think only part of the toothpaste might come back into the tube, certainly not all of it. The parts that might actually come back first, I would guess, would be those smaller countries that don't really have too many real structural or systematic or philosophical issues with the U.S. That the U.S. probably views as allies historically, and actually needs to rely on more to reduce the reliance on markets like China. So some parts of Southeast Asia, for example, have indicated they've started to negotiate with the current administration. I would guess that those guys can probably get a deal done sooner. So I think we'll have to watch over the coming weeks what happens, but China is probably not going to be a high priority in terms of negotiation, relatively speaking.
Right.
Okay, so China's not a high priority, but it's also that question of how much has been priced in at this point and how much further selling pressure do we continue to see?
Well, for the U.S., I think, unfortunately, this is a huge wake-up point for everybody, right? I mean, we thought there were tariffs coming on Liberation Day, but nobody thought they were going to be so egregious. Right. And certainly the degree of retaliation from certain markets has been a negative surprise as well. On Thursday, the market selling was somewhat orderly. On Friday, after the China retaliations, people thought, oh my goodness, this is actually, just the beginning, and this could actually get worse. And then we saw very rampant de-risking across the board in terms of equities as well as credit spreads, et cetera.
Would you agree with the likes of Nouriel Roubini, who says, short of a Xi-Trump phone call in the next day or two, this volatility and sell-off likely will continue? Also, help Bill Ackman saying, right now, Trump needs to impose a 90-day moratorium, a pause, to let the market sink in what the impact is going to be long term, rather than have it on April 10th?
Well, I think a 90-day moratorium isn't necessarily going to be his first choice. He obviously wants to use shock and awe to push people to the negotiating table. 90 days is probably a little bit too long. They've also mentioned that whoever comes to negotiate first might get the best deal. So again, that's pushing other people to come first and ASAP rather than wait for 60 or 90 days. So I think the 90 days is not that likely. But I do agree with the other comments in terms of, so long as this uncertainty remains, then I think the markets are going to continue to be under pressure. The U.S. market has derated from 20-something times to like 18 times, but that's on the current earnings. People are now expecting that recession risk could be as high as 50 or 60%, in which case probably the earnings are a little bit too high and the multiple is too high. So if this doesn't get sorted out in a meaningful way, yes, we do think that there could be further downside in the near term.
And I think we're going to get earnings kicking off as well in the U.S. later this week. So what exactly are you going to be listening out for? I mean, companies need to be at least signaling how they intend to deal with these tariffs as well.
Well, I think people won't care that much about the backward-looking first quarter results. Unfortunately, they're going to be really looking for management for guidance. I think most management are going to be very cautious as to the degree of optimism and confidence that they convey in the message. Many of the companies did say that they plan to pass on the tariffs, but, there could be volume issues in terms of maybe consumers or channel already stocking up in the first quarter or in the fourth quarter of last year ahead of the anticipated tariffs, and therefore demand falling off, or there could be other types of reactions as well. It's very likely and possible that as you pass on the tariffs to the consumers are going to say, well, you know what, I don't actually need this item, or I feel very uncertain about my future. So I do think that there is going to be a lot of mayhem in terms of the results, forecasts, and guidance in the season upcoming.
I know we're going to talk about China more as the morning progresses, but what did you make of their response Friday on a holiday as well, and the market opening up again in just a few minutes? It's going to be significantly tumultuous, I would assume. But did you basically feel that the Chinese economy is tariff resistant, more so now than in the first Trump trade war, or less?
I think more tariff resistant versus the previous trade war, because a lot of stuff has been migrated offshore, and also I think China has actually adjusted some of the trading balances according to some of the settlements in the first trade war. However, the magnitude of the tariffs on the same categories of stuff has certainly gone up substantially more, and therefore I think that will have its own impact as well. I think that it's not a surprise that the Chinese retaliated, as people had been anticipating, but I do believe that there needs to be some kind of deal between the two sides in order for global markets to stabilize. And I would actually agree with Bill Ackman's comment as well, that if this thing isn't sorted out soon, not just between the U.S. and China, but this entire trade uncertainty overall, I mean, honestly speaking, the faster the market crashes on a daily basis, the more pressure it's putting on Trump to do something. Otherwise, it becomes a self-fulfilling prophecy of recession.
Right.
Just stay with us, Helen. We're going to bring in our China correspondent, Min Min Lo, now. And just on that point of China, how it's been retaliating. I mean, we heard from Trump this morning again talking about how China has been hit much harder than the US, and he's not open to making any sort of deal until China solves the trade deficit issue.
Yeah, he said China panicked and made the wrong decision with the retaliatory tariffs of 34% on Friday.
But let's get to Min Min then. So, I mean, panic or not, what has been the response so far?
Yeah, I think analysts generally disagree that China panicked. I think so far what I've read from strategists is that China had been very targeted and very measured in that response. Yes, they responded earlier than usual. They didn't wait until April 9th when the tariffs kicked in to respond. And they responded proportionally, right? 34% on U.S. goods, as well as some non-tariff measures, including export controls on over a dozen U.S. companies, export controls on some of these rare earth materials as well, but very targeted in the sense that they still focus on certain sectors like the agricultural sectors, the defense sectors, which are Trump's key constituencies. And early this morning, we got People's Daily Commentary on the front page saying that China is going to take extraordinary measures to support the domestic economy, domestic consumption, stabilize the stock market. They might use cutting of interest rates or triple R where necessary. So it looks like they are focusing on supporting domestic economy while they take all the necessary preparations against these external shocks.
Well, they do have fiscal levers still to pull and monetary as well. But what about the yuan? So far, they've kept it fairly stable throughout all of this. And that is something Pan Gongsheng, the PBOC governor, has talked about, the stability of the yuan. First trade war, in those 2 years, we saw the yuan depreciate some, what was it?
11%.
11%, I think, over a couple of years, right? So is that in the cards, potentially, a weakening?
Yeah, I think this is where there is a lot of market chatter, and it does look like the market really doesn't know where the yuan is going to go, because you have some strategists saying that maybe China will do the same thing as before and weaken the currency by 15 to even 30% within a couple of months. Others are saying they're going to take a more measured response, just weaken it to the tune of maybe 3% in order to push that inflationary pressures back to the US and also take care of all those concerns around capital outflows and shocks to the Chinese equity markets. And then you have Ray Dalio, who's arguing the complete opposite, saying that China could come into a deal where they strengthen the currency in order to have lower tariffs. So we have all these very different competing narratives. Actually, it'll be interesting to get Helen's take on this as well.
Look, I think they're going to be very cautious about devaluing the currency because, that's going to look very antagonistic and belligerent. And frankly speaking, we all know that China has a lot of concerns regarding capital flight and domestic concerns about the stability of the currency to start with. So I think if they were to meaningfully depreciate the currency, that would not be moving towards the direction of getting any kind of compromise with the U.S. My guess is that the best approach is to keep the currency roughly stable within 2 or 3%. And the dollar index has come off quite substantially versus Inauguration Day already, so down 5 or 6%. So that naturally takes off a lot of the pressure off RMB as well as other emerging market currencies that are affected.
All right, Helen Ju, managing partner and CEO of NF Trinity, is staying with us, and that was also our China correspondent, Min Lo. And we are very early into the session so far for some of these markets, but Taiwan is just back from an extended break, and you're seeing a very, very sharp sell-off so far. We're actually more than 20% now from the July peak, and at TSMC, for instance, one of the names really standing out, you're seeing, again, pretty much the same magnitude, the heaviest weighting on the benchmark there. Counting down, of course, to the open of trade in Shanghai, Shenzhen and Hong Kong. And if you take any sort of indication from the Golden Dragon Index on Friday, this is going to be a very, very ugly day across markets.
Ugly Monday after an ugly Friday and ugly Thursday, right?
And probably more ugliness throughout the week. All right, you're watching The China Show. We'll have more ahead.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world.
That was President Trump dismissing market concerns as he heads back to Washington aboard Air Force One after a weekend of golf, actually, in Florida. I don't know what to make of that, but one thing I would say is that he's certainly brushing off the market that we're seeing so far. He's saying that he didn't intentionally put this sort of market action in place.
Well, the commentary that I've been seeing coming out of Wall Street has been, please call a mulligan. A do-over on this, but I don't think he plays golf that way.
All right, the Yuan fixture's coming out as well, and it's come in line actually pretty far away from what estimates had been, so 7.1980 per US dollar. The estimate rather had been for 7.3122, but certainly we had seen a lot of diverging expectations around the Yuan fix ahead of that today, because it's going to be really critical to try and understand exactly what the PBOC intends to do with the currency, because it really is a very tightrope here, essentially. You can't let it depreciate too far, otherwise you anger Washington, but at the same time you want to keep the currency competitive as well.
Yeah, absolutely. So it's a different approach than the first trade war, as we talked about with Min Lo. But again, there is some wiggle room there with the yuan having stayed fairly stable. But there is going to be pressure on exporters for sure. Let's bring in our Asia government and economy correspondent Rebecca Chong-Wilkins joins us for more. Is there any sense that the Trump team are possibly rethinking their tariff strategy? I mean, it's defiance from Donald Trump so far, obviously, but Bill Ackman and others saying 90-day pause. Push the pause button for now and let the markets digest this.
I mean, I think the short answer is no. We've seen this, as you say, this really defiant tone from Trump. And in fact, he sent out all of his top economic planners over the weekend across the airwaves to really reiterate that message. So we had, while he was playing golf, we had Peter Navarro, the trade czar, for example, emphasizing President Trump's determination to follow through on this. We've also had the likes of Lutnick and Bessent making similar comments. Bessent emphasizing that now 50 countries have approached the US to have these discussions and have this debate over, and negotiate over the tariffs, essentially underscoring the success of this so far. And there does seem this feeling that, Bessent saying that the market consistently underestimates President Trump and essentially sort of keep calm and carry on. Things will eventually sort of work themselves out.
But at the same time, I mean, you're getting a lot more calls for recession as well. And so what are they saying about those risks?
Yeah, that's absolutely right. We've had the likes of JPMorgan raising their recession risk from 40 to 60% and so on. Bessent has been very defiant, particularly on this point as well, saying there is no need. But, of course, we do also, parallel to that, hear these calls about the Fed and the need for Powell to step in. So President Trump saying this could be a great time for an interest rate hike, for example. And we have had Powell himself coming out and saying this does now significantly increase the chances of inflation and so on. I mean, the under sort of lying theme, I suppose, is that during this second presidency, we have seen President Trump focus far less on the stock market performance and far more on that 10-year Treasury rate. He has just simply been sort of seeming to be more tolerant of pain in the markets so far.
Yeah, that's been really one of the interesting dynamics. Not as much concern for equities, but that laser focus on what the 10-year Treasury yield is doing. But that was Rebecca there joining us, Rebecca Chong-Wilkins. And let's bring back Helen now. Helen Zhu, who's also with us, managing partner and CIO of NF Trinity. So, I mean, you were just referring there, Steve, to that interview with Nouriel Roubini early this morning, saying that there's a game of chicken, really, that involves Trump, Powell, and then also Xi Jinping. But essentially, Trump wants Powell to act, that's the comment he's making, and to do something about rates as well. But do you see the Fed?
I think it's actually between Trump and the markets at this point, not necessarily Powell and Xi Jinping. I think from Powell's perspective, as he commented, there are, conflicting aspects at play here. There's potentially much higher risk of recession, which would actually suggest that you should potentially cut rates and faster, which is what Trump is trying to push him to do, and probably what most of the market is expecting. On the other hand, you have concerns about inflation coming in, right? So Powell, I think, is going to stay put for a period of time and just watch how things fall out. If credit spreads, which have already gone, headed up vertically, if they actually break through some kind of level that brings systemic risk to the system, maybe he could, relaunch QE or something like that as a emergency backstop. But that's probably not going to be a first priority. I think it's really about Trump watching the market and thinking, gosh, if everybody's wealth effect is going deeply negative, if corporates are not going to hire people, if people are not going to go out and consume, and everybody's just in complete and total, disarray and shock, then what's that going to mean if I don't settle this thing sooner rather than later? Even 90 days might be too long. 90 days is probably enough to potentially accelerate the pace of falling into a recession. Right. So he needs to think about, actually, I think the worse, the better, as in like bad is good. If the market keeps crashing this way for another 3 or 4 days, he's going to have to come out and do something or say something.
Right.
I just want to pick up on your point there about credit spreads, because we have seen them blow out, particularly in this part of the world, and we're expecting to see that continuing through today. How wide do you think we go on Asia investment grade, Asia high yield, and what do you think we might see other countries doing to manage some of that risk?
Well, everywhere has seen credit spreads, go up. So that actually, by the way, offsets the argument that so long as the 10-year is lower, then everybody's better off because, the 10-year indeed has come off from, 4.3 to 3.9, so 40 basis points. But credit spreads, IG in the U.S. was 70-something basis points at the beginning, is now north of 100. So you're basically offsetting a lot of that. And if you actually think about it, yes, maybe lower-end households save a bit on their mortgages, but they're going to have to pay a lot more for everything else that they're buying. So I don't know if that, mixture actually works out in the lower-end households' favor.
We're just seeing the futures on the Hang Seng China Enterprise Index, the HCI 8-share index, pointing at a 9.9% fall at the open. The Hang Seng Tech Index also down another 11%. So Donald Trump talked about appealing to investors to hang tough. Another World War II saying. Rebecca talked about keep calm and carry on, and now we're talking about hang tough, which was commonly used during D-Day. I hate to get into historical lessons here now, but how far do we hang on? Hang tough.
Well, I think one thing that China has in its favor is that Chinese are better at expectation managed by the government and hanging tough versus Americans. Americans won't listen to the government even if there was, a huge meltdown of the, not only the economy, but even if aliens invaded and the government said, do this and don't do that. Or, during COVID, for example, right? Obviously, Chinese followed rules very, very closely and followed the directions, and Americans simply didn't. So I don't know how long this hang tough message is going to work in the U.S., especially when the household wealth is so tied to the equities compared to China. In China, really, a very low percentage of people have their wealth tied up in the equities market, and the government is actually actively intervening in the equities market to stabilize expectations versus the U.S.
All right, Helen, you're sticking with us. You're going to be with us for the market open as well in just a few minutes. That's Helen Ju, their managing partner and CIO of NF Trinity, and as well our Asia economy and government correspondent Rebecca Chung-Wilkins with us in studio this morning. But as we said, pre-market session just getting underway, and there is plenty of red across the screen. It's important to note as well, this is the first time that Asian markets have been able to react to China hitting back at Trump with the tariffs as well. And so you're seeing really very, very steep losses that are being indicated here for the likes of Alibaba, Xiaomi, HSBC as well. But across the board, really, for pre-market in the session today, we can expect steep losses, tracking what we've seen at the end of last week, what's indicated in other Asian markets today as well. We'll have more ahead. This is Bloomberg.
I think the hardest thing for the markets right now is not only to try to evaluate where the destination is, but how bumpy will the journey be.
There's going to be stickiness to these tariffs. And even if there are some negotiations and some concessions along the way, I think the direction of travel here is very clear. Tariffs are going to be high, and I think they're going to be high for a while.
If you go back to Friday, the Fed can talk tough. They have to be looking at this. I don't know if they can even make it to the May meeting before they start bringing rates down. I think this is a serious moment. I do not think the Fed can just sit on the side.
In the past, the Fed, like in 2018-19, blinked when there was a real massive spike in high-yield spreads. And if things continue in this direction, high-yield spreads are going to go even higher, and that's a breaking point.
There were some of our guests speaking earlier on a special edition of Bloomberg Surveillance. And if you're just waking up this morning, I mean, maybe actually just snooze the alarm for another 10 minutes because it's certainly not a session you want to be taking part in today, given how much selling we are seeing across the screen so far. This is not just Trump putting these tariffs on. It's also that reaction to China retaliating as well, because they've included or put on a 34% levy on all American goods starting later in the week.
And welcome back. You are watching the China Show. We're counting down to the open of the markets in this part of the world as we're seeing, Annabelle, not pretty numbers.
No, that's right. I mean, it's certainly, we already had the indications of that on Friday when we saw the Golden Dragon Index, for instance, closing down nearly 10%. And markets were shut as well in the mainland and Hong Kong for the Qingming Festival as well. So it has been a long weekend. So this is really the first reaction that traders have. Yeah,
is this a third consecutive day of massive sell-off or playing catch-up in China and Hong Kong? A bit of both.
Yeah, that's right. So we've got mainland markets. Again, we are setting up for some very steep losses here across the board. And as we were saying as well, it's not just these Trump tariffs. It's also the China response that we had going into the weekend, where they said that they were going to be announcing duties, reciprocal duties of more than 30%, and also restrictions on certain rare earth metals exports or materials exports. But here you can see, that is a nearly 5% drop that we're seeing for the CSI 300 so far. Again, you're seeing that flight into safety, and you've seen the Japan government debt that continues to be bid, and so you're seeing those yields that are moving, but in line, I guess, of what we've had for other bond benchmarks in Asia. Commodities under pressure. Shanghai crude, again, a drop there of 7% that you see. Not just the concern around tariffs, but also you saw Saudi Arabia over the weekend dramatically slashing their crude prices by the most in more than 2 years. China is coming out and saying that they're going to have their own measures to try and stimulate domestic consumption, but still you're not seeing that translating so far into names like Midea, for instance, down nearly 7%. But let's take a look at what's happening in Hong Kong, because in pre-market we had seen some indications. The tech index, for instance, down 10% there, really feeling the pain across some of those names like Alibaba, for instance, Baidu, Meituan. But HSBC, that's a drop of 15% for the stock so far. As we said, one of the areas that could trade a little bit differently in the session today are some of the tech names in particular. Let's just take a quick look at those that we can see. Again, really steep. HSBC, as I said, down 15%. But China Rare Earths, this is where China says that it's putting export controls in place. They're saying it's not going to be impacting the stability of the international supply chain, but you can see some of those, I'm not going to say beneficiaries, but just the market reaction as well.
Yeah, haven't found too many beneficiaries in the last 3 days. Let's bring you back in. Helen Zhu, managing partner and CIO of NF Trinity. You're still with us, of course. That's the beneficiary of our audience here. So how do you, this is a stupid question, how do you play this market? I mean, I know one fund manager that we quoted in one of the Bloomberg most read stories, unwinding about 40% of his holdings through this, uncertain times. What's your advice?
Look, we think it's a little bit too early to buy into the U.S. market as a whole. Valuations haven't come down that much. The recession risk is not in forecast yet in terms of companies' earnings. And certainly the positioning has been very, very concentrated. And I think the retail capitulation is just starting. So we don't think that's an area we want to necessarily jump into first. But if you actually think about some of the other areas, like those Asian countries that are actually U.S. allies that maybe are likely to negotiate first, their share prices have come down quite a lot as well. And if they get exempted or some kind of compromise in the coming 1 or 2 weeks, then they could be the first ones to rally. Mexico got hit very early on, well before the Liberation Day, because of the concerns about the tariffs. Then it turns out they got no incremental tariffs on Liberation Day, and the market actually, performed very, very well, relatively speaking. So I would say be more selective and try to pick your spots and try to bet on which markets might get some alleviation first, if that's the way that you want to look at it. But overall speaking, people were going into defensives early on, but we were thinking we got to get out of defensives too, because once the rampant selling starts, people want to take profit on the stuff that has done not as badly. And so everything actually comes off equally.
So you're at the point, though, where you're just looking at a country basis. You're not even sort of sector specific, because if I think about the countries that are most likely to negotiate first, it could be Korea, for instance, despite the political instability there and elections on the horizon, but Japan, Taiwan maybe. What is that where you're at right now?
Well, most of the tariffs that came out on Liberation Day were country focused, right? And we don't know what kind of formula was used to come up with the percentage of tariffs, but they were based on the deficit with that particular country. Of course, there are certain sectors that have individual situations like autos, et cetera. There are certain countries that are very overly reliant on certain sectors like tech, which might actually see demand destruction if the U.S. economy, falters. So those are things that we need to take into consideration. But generally speaking, I think the likelihood is that, the administration does not want the dollar to sharply appreciate again as the yields on the long end come down because of all the recession concerns. Then we probably want to look into potentially buying into non-U.S. markets first for the potential rebound and any compromises or negotiations.
And China as well. I mean, there are traditional safe havens in times of turmoil like this. Gold in the currencies, the yen, we've seen a 1% pop upwards today. It's paired some of those gains a little bit now. But are there select areas in China, if they can weather this, or stay away?
China has done really well this year so far before this, right? And the market has already normalized to a better valuation. Not a high valuation like the U.S., but certainly certainly a better valuation versus where it has been previously. A lot of that was actually led by the tech and internet sector, but I think those names are actually potentially in the crossfires of all of this geopolitical instability, not necessarily in terms of tariffs, but other types of restrictions that could come in, which could actually longer term be even more detrimental than tariffs.
But what about the reflationary policy that is probably coming, the further reflationary policies?
I think those will certainly help, but it's kind of trying to dilute the negative impact rather than create huge positive impulses. Actually, you're right. If you actually think about it, China's exports to the U.S. are only low single digit of GDP. So the reality is the direct impact is not so significant, but the indirect impact in terms of the sentiment overhang, the uncertainty, the impact on hiring, on consumption, on wealth effect, those will continue to be an overhang for quite some time.
So you don't see opportunities in China right now, even if you've got officials that are signalling that there are things they can do around stimulus measures or on rates? You don't actually see any opportunities in China.
I think relatively speaking, if the reliance is on domestic economy, probably the areas to benefit are going to be infrastructure and cyclicals. Property, obviously they've U-turned on policy towards property very clearly already, and prices are practically stabilizing to some extent, and then consumer. But I think that if the global market sells off the way that it is right now, China is not going to be able to go up either in terms of absolute performance in the near term.
What further retaliatory steps do you think China will take, or is it more of a pause and make sure that the United States doesn't do another retaliation as well or add to it?
I think China would prefer to pause and see what happens. And then I think if other countries do approach the U.S. first with a very attractive deal, as Trump put it, and Trump does settle a deal with some of those other countries, then I think that's going to give the market some degree of comfort, and we might have a little bit of a stabilization. And I think other countries that may have a tougher time with the current administration will try to study that and how that went and what's the playbook before they actually, come to the negotiation table.
What's the point at which you step in, though? Because, it sounds like at least what I've understood is that you're still expecting further losses. What's the point that you think markets start to look a little bit attractive and you'd see perhaps buying opportunities?
I think if there is, collateral damage in areas that have really very little to do with this, but simply because of overall market sell-off, and areas that are already pricing in recession risk, and really, have been quite depressed all along, those might be interesting. Some of the global cyclicals, like chemical industry, for example, has been in a market trough for a very, very long time and has all been trading at historic low multiples and PB. So that might be an interesting area to potentially step into that has relatively limited downside and some potential upside if the growth outlook should improve. Some REITs are actually fairly defensive in terms of the stickiness of the economy, so long as there's no major recession. And obviously yields going lower potentially helps their fundamentals as well. Those are some of the areas that we will actually think about, but not necessarily the traditional defensives like the telecoms and so on. Those have already performed very, very well in the global markets, and now they're kind of the victims of profit taking as well.
If we take a step back and look from the historical perspective, Lawrence Summers was talking about this being the biggest two-day sell-off in the S&P 500 since World War II, the fourth biggest.
I think it's worse than COVID.
Yeah, 1987 crash, the 2008 launch of the global financial crisis, then 2020 COVID. So what has history told us about how we tend to get out of this, or are we in unprecedented territory?
We came from a relatively high starting point in terms of expectations, positioning, valuations, and everything in the U.S. market. So that's why I think the shift or the delta of change versus the very high point of expectations is very, very sharp. So the ways to get out of it would be either we continue to fall to a degree that pretty much the earnings decline as well as the valuation multiple are all reflecting recession assumption already. Then I think it's time to step in. I think, if this continues for another couple of days, that we could actually already be there, right? And you probably do want to step in and start to nibble when there is some panic and blood on the streets. Or there's all of this lack of stability is pushing Trump to actually inflect and start to show that he's willing to negotiate to some extent. Or the Fed says, you know what, I can't take it anymore. I'm going to come in and do something. But I think the third is actually probably going to be later on after there's a lot more mayhem. And honestly, the Fed alone cannot resolve this issue without any compromises by the current Trump administration. So I wouldn't rely on the third.
Rubini says, it's not going to de-escalate until Trump blinks and de-escalates.
Well, definitely at this stage, he's signaling that he is not going to be the first one to blink either. So, I mean, you can say uncertainty is definitely the word of the day, if not maybe 2025. But anyway, all right, Helen, thanks so much for joining us. That was Helen Ju there, Managing Partner and CIO of NF Trinity, and taking a look at some of the biggest losers so far in the sessions today. It's very broad-based, the selling, but a couple of the names that are standing out to us are AAC Technologies, Lenovo, Wuxi Biologics, as well, Sunny Optical. Some of these are Apple suppliers, and I think this is a very interesting point because, and this is what the point that Mark Gurman, our Apple reporter, is making, is that in a world that has been so constantly marked by upheaval, one of the few constants has been Apple not shifting on its iPhone pricing, and it's kept it very consistently at $999.
Well, if I can extrapolate on that, they likely have to raise prices because they've divested not out of China, but they've diversified. India makes increasingly iPhones and AirPods. Vietnam, iPods, AirPods, I should say, iPads, Macs and watches. Malaysia, Thailand, and of course Taiwan being such a component sourcing place.
Yeah, so that's, I guess, what you're seeing reflected there is just the risk to a major company like Apple that actually managed to have its iPhone struck off in the last round of tariffs back in the first Trump 1.0. Doesn't seem likely it's going to have that same sort of pass this time around.
Yeah, that's right. Well, guess what we're going to be talking about the rest of the morning? Coming up in the next hour of the show, yeah, you guessed it, more talk about what's happening in the markets. We take a closer look at President Trump's moves to stop China's dominance in shipbuilding. The Center for Maritime Strategy and the Mercury Group join us with their insights. Much more ahead. You can guarantee that. This is Bloomberg.
You're watching The China Show, and we're taking a look at how some Southeast Asian markets are faring. Manila just coming online, or the Philippines off 4%, not really seeing the magnitude of the losses elsewhere, but that is an economy that's more insulated, more domestically driven. Singapore, though, you're seeing a lot of selling there, extending, and also India futures, again, a little bit under pressure so far. What was interesting, actually, Helen Ju, who was just joining us earlier, was saying that smaller countries or US allies such as Vietnam, other Asian or ASEAN manufacturing markets like India, Japan, they could actually be able to negotiate with Trump first and maybe get some sort of relief.
I think a lot of market participants will look how those negotiations are going and then maybe borrow a few pages from the playbook. We'll have to see, though. China is a bit of a different game, obviously. Southeast Asian nations, though, are among the hardest hit by U.S. tariffs. Malaysian Prime Minister Anwar Ibrahim is pushing a coordinated regional response, and Vietnam is offering to remove all tariffs on U.S. imports. Bloomberg's Avril Hong joins us now from Singapore. So, Avril, give us your take on what's happening in Southeast Asia. Vietnam stands out in ASEAN as it was hit by, 46% tariffs. How effective might be its offer of zero tariffs?
Yeah, Steve, I mean, we heard how in a letter seen by Bloomberg, Vietnam's leadership is offering zero tariffs in exchange for no additional tariffs from the US or a delay of 45 days. The imposition of tariffs set to take effect, of course, in the middle of this week. And this kind of just confirms what Trump had been posting on social media about over the weekend. As to your question about how effective this all could be, I think nobody's really holding their breath. Given how Trump's been doubling down and perhaps more helpful to kind of get the take from the trade advisor Peter Navarro, right? Because he suggests that even if Vietnam lowers the tariffs to zero, that it still has $120 billion in terms of a trade surplus with the US. And it's also, he highlights, serving as a tariff evading platform for Chinese exports. So it looks like the Trump administration still at this point is pretty determined to take aim at the China plus one approach. We had our colleagues at Bloomberg Economics, Bloomberg Intelligence, citing the likes of Nike, Lululemon as perhaps benefiting the most if Vietnam indeed does get a delay, but it does make you wonder, it kind of kicks the can down the road 45 days. To what extent does this help companies to plan without the clarity? We have also, the idea that Vietnam's approach could offer a sort of playbook for ASEAN, as you alluded to just a short while ago, Steve, that, they're not considering retaliation at the moment. Indeed, that is an approach that's been taken by most of the Southeast Asian countries in the region, including the likes of Malaysia and Indonesia, because this could just make it more difficult ultimately for them to secure any concessions while negotiations are ongoing. And then we also had the likes of Malaysia, which suggested a coordinated response from the bloc. But this is a 10-member bloc, so it remains to be seen how something like this would actually work. We have, this spectrum of tariff levels, 10% in Singapore, 46% in Vietnam, so very complicated here.
Yeah, in India, reciprocal tariffs of more than 25%. So how are they also likely to manage those?
Yeah, I think similar picture applies when it comes to India in that it's not really considering retaliatory tariffs. Certainly, that's the sense we're getting from government officials. One that spoke to Bloomberg reportedly also saying that India has a sort of first mover advantage when it comes to these negotiations because it said that the trade talks have already begun with the Trump administration. Again, is this idea that tit for tat at this point is not going to be very helpful for any forms of discussions, any negotiations when it comes to ironing out some form of a reduction in these levies.
All right, April Hong, good stuff this morning, a busy Monday morning, obviously. And later, we will speak to Asia's Commerce Minister, Piyush Goyal, as following Trump's decision to enact 26% tariffs. He joins us live from the India Global Forum in Mumbai. Terminal subscribers can see that on Live Go at the time seen on your screen.
Yeah, and certainly we're already seeing that the market reaction to these tariffs as well. I mean, China, we're just over 15 minutes into trade, and it's been a very, very ugly start to the week. But our Bloomberg opinion columnist, David Fickling, actually says that Beijing has managed to trade war-proof its economy and much more than what the US has done as well. But he joins us now from Sydney. So, David, I guess it sort of comes down to what China is importing, exporting versus what the US is doing, but the picture is quite different between them.
Yeah, I mean, I think it's absolutely crucial. And, obviously, countries that are the largest manufacturers tend to do pretty well in this. China is by far the world's biggest manufacturer. Its manufacturing value added is nearly twice the US is. And also, it's about the structure of what is imported and exported between these countries. And I think that's absolutely crucial. If you look at what China imports from the US, it's largely intermediate goods for industry, whereas what the US imports from China is largely retail goods for consumers. And of course, the way trade wars end, particularly where there's retaliation involved, as we've got on both sides, consumers don't like high prices, and consumers will complain about high prices. And the US tariffs affect consumers. In China, it's very different. The tariffs will largely hit industrial companies, many of which are state-owned, and certainly even the ones that are state-owned are not likely to speak up the way American consumers are likely to speak up. Look what happened to Jack Ma when 5 years ago he started talking about, innovation and financial regulation. He basically disappeared from public life for 5 years.
Hey, David, how about, offsetting between China and the United States? Where does China go? Where does the United States go? Because the United States, we saw a company like Apple diversify into other markets like India and Thailand and Malaysia, Vietnam. But now those nations have also been hit by tariffs. So it seems as though China's diversification efforts, whether it's soybeans and Brazil and the like, seems to position itself better than the United States, which some say is basically an own goal.
Yeah, that is absolutely the case. And yes, I mean, crucially, the US can't diversify anywhere else except within the US because it's putting tariffs on everywhere else. So that really limits it. But even before that, even if you weren't having that sort of self-inflicted wound from the US, in terms of the major export categories, China has a very dominant position in most of these markets. It's, sort of 30-40% in things like, smartphones, laptops. It's very hard to displace that into any other market. No other market has the capacity to do that. It's very different in the other direction. As you mentioned, soybeans with Brazil, that was actually an outcome, of course, of the first Trump trade war in the first Trump term. But also crude oil, obviously, it can import from a whole bunch of places, and actually its import from the US is very recent. LNG is another of the big import categories. Of course, the Central Asia gets a lot of gas from Central Asia. Russia has been trying very hard to export more gas to China. So it's got lots of options there. And that means, it is more trade war proofed than the US, and it's much easier to diversify away from the US. If you look back on the history of this, obviously during the sort of 2000s and early 2010s, China was incredibly dependent on the US as an export market for its goods, and the US wasn't that dependent on China as a source of goods. That situation has actually flipped in the last few years, and at this point, the US is more dependent on China than the other direction.
Bloomberg opinion columnist David Fickling in Sydney, thanks so much. I encourage all of our terminal subscribers to read his latest piece on the terminal. All right, plenty more ahead. You know what we're going to be talking about. We'll be right back. This is Bloomberg.
Less than 30 minutes into the session so far for mainland markets and Hong Kong, and you are seeing steep selling pressure here across the board. Pain really felt in all corners of the market. That's as we saw not just Trump pushing back on any of these market concerns, Wall Street concerns around the impact of tariffs, but as well China into the weekend announcing reciprocal tariffs and restrictions on exports of certain rare earth materials. But that is the market picture there. We're going to have a lot more ahead in the next hour with JPMorgan among those that are joining us.
China, it's $1 trillion, and we have to solve our trade deficit with China. We have $1 trillion trade deficit with China. Hundreds of billions of dollars a year we lose with China, and unless we solve that problem, I'm not going to make a deal. Now, I'm willing to deal with China, but they have to solve their surplus.
Well, President Trump there speaking, and welcome back to the China show. And Annabelle? Going to take a look at how the Hang Seng Index is looking?
Yeah, well,
not looking good.
It's not looking
down
good.
9%.
But I am interested to see, like we're seeing, we were just talking there in the ad break about the CSI 300, but the Hang Seng is the same. They're actually lifting off a little bit the lows of the day so far. Still very much in negative territory, so down 9% there you can see, and very, very broad-based selling. So there's really not any sort of beneficiaries except for rare earth materials linked names who actually are seeing some upside. But every single sector so far in the red for the Hang Seng, again, 30 minutes into the session. If you take a look at how broader markets are faring so far, again, it's this story of global equities that are absolutely plummeting. Investors are moving into safe havens. Let's take a look at the broader gauge now. But we've seen the yen bid, for instance, the Swiss franc as well. Here you can see, as I said, every sector in the red so far today. Bonds, though, again, you're seeing that flight into safety. Not every single corner of the market, though. Gold actually is still a little bit under pressure so far.
Yeah, I think we're going to talk a little bit about FX strategies and bonds coming up in the next block with our next guest. But, it looks like a cherry pie there in the previous screen, obviously. And President Trump has told reporters he's not making a China deal unless the trade deficit is balanced, and that's going to be a long-term process, no doubt. Let's bring in our China correspondent, Min Lo. So traders rattled by a potential tit-for-tat trade war. So what's likely to happen next? That's the big question, isn't it?
Yeah,
How much time do you have?
Well, we'll be having this conversation for the rest of the year, but I think this is the first sort of clear articulation from Trump in terms of what he wants to get from China, aside from the fentanyl issue, is to reduce that trade deficit. So whether or not China will commit to maybe buy a certain amount of U.S. goods in exchange for lower tariffs is the question. But of course, we have seen Trump being signaling that he's not quite ready to back down. He previously said that he's never going to change that policy. He said that China is overreacting and that China is hurting more than the U.S. But on the flip side, you look at what China has done, a very clear signal here that they're not going to take it lying down, and they don't seem to be in great urgency to negotiate as well. They're not closing that door, though. That is very clear. It's specifically written in the last paragraph of that People's Daily commentary that you see on the front page today. On the last paragraph, it says they are not closing the door to negotiation, but they are not taking any other chances either, and that's why they're doing everything they can to ensure the resilience of the Chinese economy, extraordinary measures to boost domestic consumption and to stabilize the stock market as well. That was the passage I was referring to earlier, not closing the door to negotiations, but we're not taking any chances. We're making all kinds of preparations to deal with the impact.
The Yuan fix as well. We had that earlier today, and our colleague Mark Cranford on the terminal is making the point that the dollar yuan fix is another leap higher, and the central bank does seem to be avoiding devaluation at this point. But how is the yuan being brought into the equation here?
Yeah, it's very interesting. You look at what happened on Thursday and what happened today with the fix. Both days, the PBOC raised it by about 0.13% higher. So very, very moderate weakening of the yuan. They're still keeping it below 7.2 yuan per dollar. So they're not really weaponizing the yuan in the way they did in the first trade war. Of course, we're still in very early days, but we heard Helen earlier saying that it really is not in China's interest to lower it too much, because that removes all the leverage that China could have in any trade negotiation. Although mid to long term, there are a lot of speculations going around, primarily because of that Xinhua article, which mentioned that China is going to take resolute measures to defend its economy, even after unveiling those 34% tariffs on U.S. goods. So people are wondering, what else is the Chinese government going to do? So some people are saying maybe they will depreciate the yuan quite quickly, 15 to 30% over a couple of months. Others are saying maybe not so much, just maybe to the tune of 3%. And then, of course, there's Ray Dalio saying that China could strengthen the yuan in exchange for lower tariffs in a deal with the U.S. Of course, that would be depressing and deflationary for China. It would mean that China will need more monetary and fiscal stimulus to get to that 5% growth.
All right, that was our China correspondent there, Min Lo, and I think we can just show the GMM function again, because I was a little bit stunned actually at the top of the hour just seeing this many black boxes, which tells you you're seeing statistically outsized moves across a lot of different corners of the market. So you've got equities here, commodities as well, bonds. I mean, it's very, very broad-based, these huge shifts that we're seeing. But let's get more with our equities senior reporter Abhishek Vishnoy joining us from Singapore. And Abhishek, what are you making of it this morning, and how are you trying to wrap your head around the moves that we're seeing in markets today?
I mean, the moves are definitely coming in the backdrop of China escalating Donald Trump's trade war. And it hasn't been a surprise since the assets in US got repriced. The only thing is that given how Asia is moving so widely, there's expectation that, like it has happened in the past several times, that you've had a very weak Friday, and then there has been assessment of what has happened. Like, it happened in 1987, and then Monday was a very big capitulation day. We saw something similar happening in the US, which is getting replicated in Asia now across the board in terms of price action, volumes. China is the worst performer. A lot of other indexes are also down, looking at grim milestones like correction, bear markets. But the key would be how the trade sort of pans out in US when it begins trading. Given how US futures are trading right now and all of the risk assets, the signals are that this bear market is deepening, and it's worrisome. It may lead to obnoxious price moves in a lot of assets. When the mother of all markets, the mother of all economies is in trouble, it will definitely have a ripple of effect.
Well, Abhishek, this looks like it's much more than just catch up from Friday's holiday in China and in Hong Kong. This looks as though, in lieu of any kind of de-escalation from the White House, which hasn't happened, and in lieu of any kind of overture from China, which doesn't seem to be happening, that this is going to potentially deepen.
I mean, that's true. And also, look, one thing to note here is that I think Trump has learned from the trade war 1.0. The tariffs earlier were just targeted on China in that regime, and this time around tariffs are across the board. So China has de-escalated its business model. Its exports are in different countries, but the tariffs have been imposed across the board. So the impact on China can be larger in current setup versus what it could have been in trade war 1, and that's why we are seeing a this kind of price reaction. And apart from this, yes, Trump has not de-escalated, but China has also moved from having a cautious, measured approach to one that's escalating a trade war that US started. All depends on what happens from now till Wednesday. I think Wednesday is the deadline for the new reciprocal tariffs, and let's see if something can be done in between. So far, if you look, I mean, the countries which have announced deals or which have had talks with Trump, I mean, it hasn't had any impact on the assets. The assets of all those countries are also down, and by big margin. So the pain is looking like it will deepen. It's worrisome, except some haven currencies and probably treasuries. Nothing is trading higher today.
What are you hearing again from the different investors and traders that you're talking to? For instance, we've seen Goldman Sachs rethinking their index targets for China. How soon are we going to see these cuts to index targets, to GDP, to earnings revisions? What can we expect over this week?
See, markets are trading 1 year forward. The probability of recession has been increased to 60% by some of the brokers. That is getting priced in. So we are trading 1 year forward what the future would look like. But the thing is that this price action, if you're not invested or if you're not fully invested, this is opening up opportunities, especially in markets which are inward looking, and which also includes China. I mean, our reporting is clearly reflecting there are expectations that if China continues with its stimulus, probably increase that, and the continued afterglow of DeepSeek's advancements in AI, it might be a buy on dip market. A shares are relatively resilient. Similar playbook for markets like India, and hopefully markets like Vietnam, etc., which are trying to assuage Trump's concerns, managing its demands. They might also saw some relative buying, but it's not a setup for market-wide buying. It's a setup to be selective. It's a setup to be a stock-specific investor in equities. And inward-looking markets, look better off, but they won't be scathed. I mean, you remember 2008. Remember, the crashes before that. They would all move in sync, in correlation to each other.
Right. Abhishek Vishnoi, Bloomberg Equity Senior Reporter, thanks for joining us. Still ahead on the China Show, the Center for Maritime Strategy and the Mercury Group both join us for a deep dive into the potential impacts of proposed U.S. port fees on Chinese ships.
Yeah, but first, more markets, of course. We've got JPMorgan Asset Management joining us to discuss the outlook for Asian bonds and also FX. Trump officials, as we've been hearing this morning, striking a very defiant tone on tariffs. More ahead. This is Bloomberg. You're watching the China Show, taking a look at how bonds are faring this morning, and you're continuing to see that flight to safety, particularly noticeable at the front end of the curve. Again, it's really the reaction to Trump tariffs, China's retaliation, and what we've been hearing from US officials over the weekend, pushing back on any sort of concerns in the markets. Currencies-wise, again, continuing to see haven bids. So, for instance, the Japanese yen, the Swiss franc have been some of the ones standing out. You are just seeing Japanese yen there again weekend, a little firmer once again against the greenback, but some calls saying we could actually get to 140 euro. I mean, it was just a story not too long ago of expecting parity, and the Aussie dollar, of course, one to track because 60 cents to the US dollar, we haven't actually seen that going back to 2020.
Yeah, you'd know.
I would know, actually.
All right, let's get more on the markets, FX and rates and everything. Bring in Jason Pang, Asia FX and Rates Portfolio Manager at JPMorgan Asset Management. Okay, what's your top line take on the turmoil that we're seeing, the reaction to the tariffs that came in last week and its impact, obviously, and what it will mean for, let's start in Asia, what it means for any kind of rate and policy response?
Sure. So I think within Asia, we've, of course, seen a fair share of volatility. You're seeing in equity markets today. But I think from the bond market's perspective, especially government bonds, that's actually been sort of also the flight to quality, flight to safe haven, if you will. The interesting sort of relative perspective within Asia is we haven't seen massive rate cuts actually materialize yet. But if you sort of include this global ROW growth decompression, we do believe that the impetus for rate cuts is certainly there.
And so when did those start to come? Because I think really the story for a lot of Asian central banks has sort of been pause, wait, continue to assess. Are the events over the weekend and last week as well enough to speed up or hasten the move to cut, do you think?
I would probably consider that it's not the time to wait. Now, I say that because when you do the street analysis, okay, we are sort of measuring first-round impact. So I can tell you regionally, 0.2 to 1% GDP impact on the first wave. What I mean by first wave is we're talking about just the U.S. to ROW reciprocal tariffs. Here's the thing. We haven't considered second round. And second round, of course, is very difficult to estimate. But I would probably say that, as you know, China's goods will become cheaper for any country that's importing. You get the U.S. shock. You sort of get the China deflationary export side of things. You have a lot of room and reasons to actually ease in that case. And the problem is you don't want to be too late. If you're too late in the rate cut cycle, I think being behind the curve can be very costly for these economies.
What if you're too early before you know what Jay Powell's going to do at the Fed?
So I think with regards to the Fed, like what was mentioned this morning from our own firm, the ball is indeed in the Fed's court. There is data dependency from what we understand, but also sort of that concern on growth and inflation. So how do you balance that at this juncture remains an unknown. Now, what is known is that either way, if you're a company, your CapEx cycle is going to be reduced. Employment spending, consumer spending, all of that will reduce within this region in particular. So all that to me still signifies the same thing is either way, you are better off in the easing cycle earlier rather than later. And if you look at Indonesia, Philippines, even Thailand, we've actually started seeing signs of that.
Mm-hmm. CGBs as well, I mean, we're continuing to see those being bid. So is that sort of an escalation hedge at all, do you think?
So every quarter when we talk about CGBs, the way that I'd categorize it is you want these bonds in your portfolio on days where you see big headlines coming through. And I think that's playing true within the past 72 hours or even the past week per se. So I think CGBs for us remain a very pertinent part of the portfolio. You want to run these from an overweight duration either way.
Why have we seen a fairly muted response on global currencies? Yes, the yen. I know you don't necessarily cover Japan. Yen is a traditional flight to safety in a bit, so it's been up about 1% against the dollar today. But why have other crosses been fairly muted?
So I think within Asia, this is a very interesting phenomenon. We've indeed seen the DXY come down quite substantially, but Asia FX is like what you suggested. Korea won, Thai baht, Malaysia ringgit, none of them have had any massive changes. And I believe that the reason for that is more about capital flow. So people have been selling, as you know, U.S. growth stock that's been being reallocated into European defense or manufacturing. Now, because of that flow picture, then to me, it warrants and justifies why euro is strengthening versus the dollar, and that shows also in interest rate differentials. Japan economy is marginally recovering, right, to some degree, so and also the flight to quality, so all of that makes sense. But I don't believe that capital flow is sort of going into the rest of the region. So we're not seeing, at least from my perspective, flow where people are selling U.S. growth stock into Thailand equity or Malaysian equity. That has not been the case, which explains this sort of relativity of underperformance within Asia FX.
And how do you segregate Asian FX further? Because we've been talking about some of the economies that are a little bit more insulated as well to these tariff risks, like the Philippines, for instance.
So I think there are very interesting opportunities within the FX region. So like what you mentioned, you want to focus some particular currency bets which are either A, compensating you enough to run the risk, and B, with lower foreign representation. So I think within the fixed income perspective, within our world per se, it's true that the Philippine peso can be one of the more attractive ones, although versus the DXY, it's not entirely clear to me that we want to run a big directional long. So I think we're more caught within the RV cycle. Ultimately, as you probably saw in the CNY fixing today, which is again marginally weaker, the CNY fix will indeed dictate a lot of what the regional outlook will play out. So I think at this juncture, we see stock picking, we see currency picks and bond picks, but of course then, we need to sort of get through the beta first before we play the alpha.
Have you read the tea leaves as far as what Pan Gongsheng and the PBOC might do on the yuan, allow it to weaken a certain percentage as they've kept it stable through these first couple of months of the Trump administration?
So the policy messaging, at least this is, my take per se, is that when you see such an extent of external trade shock globally, and of course to China as well, it's not clear to me that you can actually devalue yourself out of the problem. For you to devalue like that, it would be way too substantial. And as you know, when we saw last time, there was a 1 trillion foreign reserve loss because of sort of the FX move. So I think to me, it's more about sort of measurably containing the FX, but still marginally weakening on a trade-weighted basis. So we've seen the CFET's basket underperform. We also think, however, that you shouldn't see the FX in pure isolation. As with all policies that we've seen in China over the past decade, it's a combination policy. You're going to get fiscal, you're going to get monetary easing, probably more comprehensive than before, and you get a bit of FX weakness to compensate. So that's probably the policy mix that we're expecting within China.
Some people, though, are seeing a deliberate depreciation of up to 15 or even 30% over a short period. Others would say maybe a little bit less, but even to the magnitude of 3%. How much do you think, or how comfortable do you think officials are to let the yuan weaken?
I think 3% would be a more reasonable estimate. At 15% levels, that would imply to me that we need to see much further global equity downside to justify that. And if that's the case, then I guess everyone's global growth forecast will revise much, much lower. So that would be the view.
Ultimately, what's your take on the dollar? If, obviously, these trade-dependent economies here hit with these tariffs, they need to boost their exporters, they weaken, dollar stay where it is?
I think the idea of reaching trade balance parity with the U.S. Is quite a difficult concept within the region. So first of all, what goods will you import? What's the export or import mix that you're trying to achieve? You won't be able to sort of reach that in the very near term. So I think what I'm trying to say is this will probably be a multi-quarter type of adjustment that's required to achieve what the U.S. really wants within these trade policies. So near term, what does that mean is if equities are down, right, I need the most liquid flight to quality. I can buy yen, I can buy Swissy and all those things. But we all know that there's a constraint on liquidity given the massive liquidations we're seeing in stock. So by definition of that, you need to hold some dollars. So I think the point is that as long as you see more volatility within equity, the dollar can remain strong, even under those scenarios, because there's simply not sufficient liquid flight to quality type of assets.
Jason, really great to have you with us here this morning. That was Jason Pang there of JPMorgan Asset Management. And just as we've been speaking, we've actually had Goldman Sachs coming out, cutting their oil price outlook for the second time in under a week. And you really are seeing, markets are selling off here, or commodities at least, are under pressure as well, down to $62 a barrel. So not just the story of these tariff concerns as well. Over the weekend, you had Saudi Arabia slashing their crude prices by the most in more than 2 years.
Yeah, and the Saudi market took a hit as well. Absolutely. All right. You can turn to the Bloomberg for more on this. Go to TLive Go to get commentary and analysis from Bloomberg's expert editors. Plenty more ahead. You're watching The China Show, and this, of course, is Bloomberg. And welcome back to The China Show. Here are some of the big stories we are following today. Yes, there are other stories. Bloomberg has learned that President Trump was close to an agreement with ByteDance over TikTok's ban in the U.S., but the deal was called off after China withheld its approval for that following the announcement of reciprocal tariffs. On Friday, President Trump extended the deadline for the sale of TikTok's U.S. operation for another 75 days. ByteDance says any agreement would need to be approved under Chinese law. Bloomberg has learned that billions of dollars worth of acquisitions and IPOs are on hold as President Trump's trade war upends the global economy. Sources say ticket platform StubHub, fintech giant Klarna, and trading platform eToro have all paused their planned listings as markets extend those deep losses. The stock market rout is also affecting M&As, with companies like Saint-Gobain and KKR holding off on deals and others revising down revenue projections for the year.
Taking a look at some of the market movers today in the session as well. Actually, there are some bright spots, and we're finding those in poultry stocks this morning here. This is after China retaliated over the weekend or into the weekend and announced that it was going to be halting imports of poultry products from two American companies. And you are seeing that some of those supplies, poultry supplies in China, rising off the back. What else we're tracking, and some other bright spots, are in the rare earths firms. This again is down to these retaliatory measures. So China has essentially announced a plan to impose new export controls on several rare earth elements and related products. But, you know, there's an interesting point to be made here around what are the tariffs or retaliatory measures actually on the raw materials
or the downstream, the processed materials, right? So Helen Ju was telling us earlier that she doesn't think this is necessarily a big issue because these export controls were not on the minerals themselves, or were on the minerals themselves, not the processed part. And China processed these downstream. So it might be more an act of showmanship rather than a true retaliatory step that's going to have meaningful impact.
Yeah, more bark than bite, maybe. Yeah. But also taking a look at some of the Apple supplies, because we are seeing those tumbling in the session so far today. Apple, of course, and the iPhone really hit by these Trump administration tariff announcements, and Apple as well, especially vulnerable to tariff given it counts China as a manufacturing hub, but also that it's already diversified production to places like India, for instance, other markets in Asia. But you're taking a look there at some of the Apple movers. We'll have more ahead. This is Bloomberg. Taking a look at a live shot of Tokyo this morning, and we are seeing Japanese stocks, really following what we're seeing in other parts of the market as well, but very much under pressure so far. Japan's Prime Minister Ishiba has been coming out this morning saying he's going to urge Donald Trump to drop planned US tariffs on Japanese imports. And as well, he says, essentially what we're seeing is Tokyo just scrambling to respond to these tariffs and looking at different proposals they can make around LNG, cars, agriculture, national security. But that really does set the trend here of how different governments are trying to essentially look at what they can offer to the Trump administration.
Yeah, and obviously every economy is very different. Vietnam is very different from the Japanese economy as well. So they're looking at what kind of negotiations could be taking place and where they can borrow a page or two on how to negotiate with the Trump administration.
And actually, just on that point, I think we already saw Nissan, for instance, again, saying that they were looking to do more production in the US. But this is the state of play here for broader Asian stocks, and you can see, a near 7% drop. Every single sector is in the red. US futures still guiding for further weakness at the open today.
All right, Belle, let's turn now to one corner of the global supply chain that may become a flashpoint in President Trump's trade war. More than 80% of the world's food, energy, and other goods are transported by ocean-going ships, and more than one-third of the cargo vessels currently at sea were built in China. Compare that to the U.S., which built only 0.4% of them. But President Trump now wants to change that.
Yeah, the U.S. is planning to charge a ship's operator for visiting a U.S. port if the vessel was built in China, belongs to a fleet that contains ships built in China, or is operated by a Chinese firm. According to Clarkson Research, that could add up to levies of $3.5 million per visit. But the Port of Los Angeles Executive Director Eugene Soroka told us it could take decades for American shipbuilding to challenge China's dominance.
But to stand up a shipbuilding interest like that across the globe is going to take time. More than a decade, maybe decades, plural, to really launch. Now, there may be smaller ships that can be built. Certain crafts will come out pretty quickly, but this is a huge undertaking to shift the world's balance.
And let's bring in our guests on this topic. John McNown is the non-resident senior fellow at the Center for Maritime Strategy. Also with us is Anton Posner, CEO of the Mercury Group, a consulting firm specializing in commodity supply chain management. Gentlemen, thanks so much for joining us on this very interesting and timely topic. John, maybe I can start with you and ask you, I think you've raised some of these issues with the U.S. Trade Representative's office. What is your view on this? I mean, I lived in Guam a long time ago, and they were beholden to the Jones Act, and that caused inflation on that tiny little island to soar. What's it going to mean for these port fees and also just the length of time it's going to take to get more U.S.-made ships into the supply chain?
Well, these fees, as proposed, are, in my view, a very blunt form of tariff, and they really have an array of adverse consequences that, in many respects, make them worse than the tariffs. By my calculation, it's kind of a three-pronged test. It's going to be about 3.5 million for Chinese-built ships, but it's really almost as much for most of the others. So I calculate that, with the 39,000 container port calls per year, my estimate is going to be about $1.5 million per port call. So you're looking at about $58 billion if that volume stays. The reality is these fees are so extraordinary that they would immediately lead to changes, diversions to Canada and Mexico. There's talk of making some fee to stop that. Even if it doesn't do that, because it's on a per port call basis, you'll have carriers that go to 2 or 3 U.S. ports going to 1. So you'll have congestion and a whole bunch of unexpected problems. My biggest concern about it, or one of them that is, I think, not terribly thought out, is that these fees would apply to empty ships that arrive in America to load our exports. Grain from the Midwest, LNG exports, coal exports. So in that sense, they're really a direct tariff on exports, which my research suggests is illegal. So there's a whole array of bad consequences on these, directly also impacting the shipping industry, but really just another form of a very large tariff.
Yeah, as you pointed out, I mean, you're not just immediately hurting exports, you're also possibly hurting American jobs that are linked to those exports as well. But Anton, I'll bring you in now. These sorts of tariffs or this sort of executive action, I mean, does it create the environment in the US as well where people actually want to start putting the funding together and the resources to start to build out ship capacity?
Yeah, thanks, Annabelle. Just to reiterate something that John just mentioned, also the situation is already taking effect, even though these regulations or rules have not come into full force. We're seeing it right now as we're working with our freight team, work on exports, coal exports, other exports, that ships are just not wanting to come into the U.S. trade, or they're going to pass along those costs. We could talk more about that. But as for stimulating U.S. shipbuilding, no one should count out the ability of the American population to accomplish things when they put their mind to it. But is our mind put to it here, right? Is there a political will? Is there the ability to build this out and invest and put the infrastructure, the legal, the legislative, the union infrastructure to put in place, shipbuilding to last through many administrations of both political parties? That's really the challenge, right? It's not just signing an executive order and then heading out of the White House and then hoping that things come together. It takes real work, real deal making, real negotiating, real work to put all of the pieces in place in a government structure like the United States to get that to happen, to put build the infrastructure legislatively to make something like that happen. And it's going to take decades, as Gene from the Port of Los Angeles said.
Right. Well, this question is to John and Anton. Both of you can weigh in on this, and it might sound like the most obvious question that I might have all morning, and that is, how inflationary is this going to be? Because, again, the tariffs, according to the White House, their first reaction is the tariffs are not necessarily over the long term going to be inflationary. But this, if you're going to be charging these millions of dollars per ship, sounds extremely inflationary.
Mm-hmm. Yeah.
Yes, I think it is. And my calculations, it's less precise in terms of what the bulk sector would be, but I think you're looking at over $100 billion a year, which obviously is a significant piece of inflation. I guess the news reports I've seen have the tariffs themselves, depending on what happens with volume, being more than that. But $100 billion a year is significant. One of the real issues to me with this proposal is that so many of the terms are very imprecise. It's unclear what that means, and the most basic imprecise thing to me in the proposal is how much of this money is going into the U.S. flag maritime industry. I'm a big supporter of our merchant marine, but I don't see that much of this is going into that, In my comments, I proposed something that I thought would be more reasonable, more proportional, but a requirement was that all of the money raised would go into supporting the U.S. merchant marine, which is arguably the entity or industry that has suffered the most from the, claimed unfair trade.
Anton, do you have a comment on that as well?
Yeah, absolutely. I was a U.S. Merchant Marine officer, graduate New York Maritime College. My merchant mariner's license right behind me, right? So there's an enormous amount of popular support to have national sea lift capacity. I mean, look, let's go back to Desert Storm in 1990. The United States had to charter Soviet freighters, amongst others, to carry our military equipment to Saudi Arabia for the retaking of Kuwait. Soviet freighters, right? Let that sink in. So there's certainly enormous popular support for, when you think about it, to have national sea lift capacity and to put investment into building a strong U.S. merchant marine and a national security supporting sea lift infrastructure. But it's not going to happen by punishing in the short term, and by short term I mean the next couple of decades, devastating American businesses. This from an economic standpoint, let's look at the example I mentioned before, right? Working on a 55,000-ton coal export cargo out of the Mississippi River, New Orleans area. The ship owners that are willing to even discuss sending a ship into the river to lift that cargo they're inserting clauses in the freight contracts that put the threat of that penalty right directly onto the trading companies and the mining companies, and that means the miners and the union workers. It flows right back to them. Divide $1.5 million for a port call over a 55,000-ton coal cargo. The math is simple. That's how much it adds on top of the cost to export American products immediately. And it's happening right now, even though these regulations haven't gone into effect. We're dealing with it every day. Our clients are dealing with it every day. The ship owners are passing along these ominous clauses in the freight contracts. So it is already a reality. So this is not something that we're dealing with in some theoretical sense that potentially will come up. Sure, it's not enforced yet, and maybe it gets watered down a bit before it comes into force. But we're already dealing with it. It is already hampering U.S. import and export trade today.
Anton, I'll ask this.
I was just going to, excellent point that he makes, that it's already hampering particularly the container sector, because the cargoes are so high valued. They're more able to absorb any given amount. This ship fee thing could be devastating to so many of our bulk sectors, and so many of those involve exports. But Anton's also right that some people talk about whether it's this or something else, but it's all negotiating. Supply chains don't change on the dime. I mean, they take months, if not years, to affect. And these sort of kind of whipsaw things are already having an effect. People in traffic departments, across the country are already making decisions based on this. And, the ship fee thing will be, in my view, just disruptive and dislocating to so many of our sectors, but particularly in the bulk sector, you have the possibility that these fees will just make that cargo go somewhere else. Grain's going to come out of Brazil rather than America. Coal's going to come out of Australia. Just all sorts of adverse consequences that really haven't been thought through very well, in my view.
Mm-hmm. Yep, it's hitting farmers, it's hitting miners, it's hitting everybody along the supply chain already. Yep.
And I think we're just seeing there in this chart, China builds the most ships, but also who else builds them? It's Japan and it's Korea. So Anton and John, but we'll start with Anton here and your views for this. What is the best remedy then in this situation for the US to be building up its shipbuilding capacity? Does it need to work with its allies in this region, Japan and Korea? Or does the government need to look at subsidies, for instance, because it's just much, much, much more expensive to build out a ship in the US today than it is in China?
Right. Yeah, Annabelle, good point, right? And there was a great Bloomberg video essay came out a few days ago on this and why China has become the shipbuilding powerhouse that it is. And it discussed in that piece, it discussed exactly what you mentioned, right? We'd be better with a strategy that included our allies, right? The allies that we need, that we count on, that we trade with, that have extensive shipbuilding capabilities like South Korea and Japan. It's going to take work, right? It's going to take diplomacy. It's going to take alliances. It's going to take a serious amount of deal making, right? I keep using that term deal making for a reason. I think it all hits home when we know who we're talking about, right? But it takes basically rolling up our sleeves, having a government that's serious about this, that's not just looking for the press op, right? For the camera ready. What the work that needs to be done means building a coalition, figuring out what pieces of the shipbuilding puzzle are best done domestically in the United States, what's best done in partnership with our allies overseas, in employing their expertise, their capabilities, their infrastructure and capacity, right, to get this done. So it's not something that I know I keep harping back on this, right? But it's going to take the real work, the non-sexy work, right, behind the scenes to get things done. That's not exactly going to be a great camera op.
John, do you have some thoughts on that?
When I look at our maritime sector, I see our most pressing need is sea lift capacity. Vessels that have U.S. crews, even if they're built overseas. And that's where we can make some real strides and have that be effective right away. Ideally, obviously, I'd love to see more shipbuilding activity. The notion that we need to build ships in the U.S. that'll be involved in international commerce, that's going to be a long ways off. I think there should be much more cooperation on ships that we built for international with our allies in Japan and Korea. But the premise of a lot of this, that somehow our problem in shipbuilding relates to China, just isn't really factual. I mean, China is certainly the biggest now, but prior to that, it was Korea and Japan who are our allies. So I think there's a lot that we can and should do. In the proposal that I recommended, I suggested a per container fee, but there would be no fee if it was a U.S. flag vessel. And the numbers were such that that would encourage people to reflag a vessel, which can be done very quickly. So I think that's where we can see the most pronounced beneficial effect immediately on our maritime sector, is to encourage more U.S. flag vessels.
John, thanks very much for your time, and Anton as well. That was John McCown there, non-resident senior fellow at Centre for Maritime Strategy, and also Anton Posner, CEO of the Mercury Group, talking about the US's shipbuilding ambitions, and very important topic, especially as we really look at that increasing competition between Beijing and Washington. We'll have plenty more ahead. This is Bloomberg. Taking a look at how metals are faring this morning, and it is a real pressure we're continuing to see here, particularly noticeable in copper. I mean, it's a global bellwether, and it certainly expresses concerns around tariffs and also recessionary fears on the horizon.
Yeah, that's right. I mean, it was just a couple of weeks ago, copper was soaring through the roof, right? Look what it's doing now on the fears that a global recession perhaps is on its way, right?
Yeah. Let's bring in our Bloomberg commodities reporter, Martin Ritchie, joining us. And exactly that, Martin. I mean, you know, we had seen a pretty sharp run up, and there were concerns around supply constraints, but it's a very different picture today.
That's right. It's been a very wild few weeks, few months for copper. We've saw prices really rally up last month and earlier in the year amid fears of sort of global shortages. A lot of copper rushing to the US to get ahead of potential copper-specific tariffs over there. So there's been a lot happening, and this morning, we all expected to wake up, obviously, and see a lot more mess in the markets. Copper fell as much as 7.7%, and that meant it was heading for perhaps the worst three-day gain since the great financial crisis. But in a slight twist, prices have actually started rising again, so erasing all those losses and rising. So you can see that markets are very jittery as they sort of gauge whether all the panic around that's in the equities markets, that's obviously around worries in trade, whether that really translates into worse demand for copper. So definitely going to see a lot more volatility in the coming days.
So where does that leave prices by week's end, say? Because I thought there was a tightening supply dynamic.
That's kind of the broad theme that underpins copper at the moment. Like, prices are relatively high versus history. So we always talk about the long term for copper, how there's not going to be enough supply to meet demand. But when you have these big macro events like the rolling out of Trump's tariffs last week, China's response on Friday, it really gets caught up in all that panic. And I wouldn't like to, in fact, I shouldn't make a guess about where prices are going by the end of the week, but I did see a quote from one analyst from Citi saying, you know, this is not the time to be trying to catch falling knives. That gives you an idea of the kind of uncertainty in the market.
All right, Bloomberg's commodity reporter Martin Ritchie, thanks for joining us this morning on an important day here, obviously, on the markets. You can also turn to our Bloomberg for more on this. Go to TLive Go to get commentary and analysis from Bloomberg's expert editors. Plenty more ahead. You're watching The China Show on Bloomberg.
Taking a look at the market action this morning. I mean, we're 90 minutes into the session so far for Asian or Chinese equities, and taking a look at trading volumes here, essentially, and we are really elevated, about 140 times or 140% more than normal. You can see here the line in dark blue is average turnover on a 20-day moving average basis. The dotted line gives us the projection for the session today. So really very active trading sentiment, but investors investors, as we know, are trying to grapple with a lot of different market dynamics. You've got the tariffs, you've got the Trump administration pushing back on any of concerns around the tariffs, Wall Street weighing into it, Bill Ackman, for instance, saying it's a mistake, and you can add to it as well China's response, even if it is more bark than bite. But taking a look at how Hong Kong is faring intraday so far, and at the top of the hour we had sort of started to lift a little bit off the lows of the day, but certainly we're back down to around a 10% drop. Again, on the Markets Live blog this morning, Mark Cranfield is saying that, you know, investors could be hopeful for onshore authorities to provide market support, but not going to be enough to reverse those losses for today. Taking a look at broader markets here, again, a lot of statistically outsized moves. You can see those black boxes means it's irregular, and it is a very irregular session so far.